All right, today we're diving into a pretty bold idea. The argument that Bitcoin isn't just another asset, but that it's on a path to become the world's most important collateral, the actual bedrock of the entire financial system. So yeah, let's break that down.
Okay, but to even start to unpack that, you've got to ask a really basic question. What is the real foundation of our entire financial system? I mean, what's the one thing that truly holds it all together?
Now, your first thought is probably money, right? Or maybe stocks, and that makes sense. But the argument we're looking at today says, nope, both of those are actually secondary. The real foundation is something totally different.
And that something is collateral. It's the stuff you can borrow against. Simple as that. This is the real engine of our economy, the thing that fuels all the credit and leverage. And here's the kicker. The quality of that collateral, well, that determines how stable the whole system actually is.
So, okay, what makes one asset good collateral and another one not so good? We need a framework, right? A way to judge. And that's exactly what we're going to do. We're going to look at the essential qualities of what's called prime collateral and use that as our measuring stick for Bitcoin.
And according to the thesis we're exploring, perfect collateral really comes down to 6 key things, 6 pillars. You're looking for absolute scarcity, sovereign ownership, global liquidity, cheap security, institutional standardization, and finally, political neutrality. Think of this as our checklist, our scorecard.
All right, now for the main event, the big comparison. Let's put Bitcoin head-to-head with the traditional heavyweights. We're talking gold, bonds, and real estate, and see how it actually stacks up. First on the checklist, scarcity. And this is a huge one. The key here is the difference between relative scarcity and absolute scarcity. See, we can always find and mine more gold, and we all know governments can print fiat money, well, forever. But Bitcoin, its supply is hard-coded, fixed, capped at 21 million, period. You just can't make more. It's impossible to inflate.
Next up, Pillar 2, ownership. Think about it. When you have money in a bank, you don't truly own it in a final sense. Your ownership is contingent. It depends on the bank's permission. They can freeze it, they can seize it. With Bitcoin, if you hold your own private keys, you have what's called sovereign ownership. It's yours, full stop. No one can take it from you. And for collateral, that's a game changer, an asset that can't be confiscated.
Okay, let's talk liquidity. How quickly can you turn it into cash? Real estate is the perfect example of something that's super illiquid. It can take months to sell, it's expensive, it's stuck in one physical place. Bitcoin is the polar opposite. It trades on a single global market that is always on, 24/7. You can send it anywhere in the world, instantly, with no one's permission. That is exactly what you want for collateral that needs to be valued and moved on a moment's notice.
So when you put it all together on a scorecard like this, the picture gets really clear. Look at how Bitcoin's sovereign ownership just completely contrasts with everything else, which is either custodied by someone else or tangled up in legal titles. It wins on absolute scarcity, and it wins on 24/7 global liquidity. And then you throw in storage costs. I mean, think about what it costs to vault gold or maintain property. And suddenly, the argument that Bitcoin has a fundamentally better profile as a collateral asset, well, it starts to make a lot of sense.
But having the best properties in the world doesn't mean anything if nobody can use it. That's only half the battle. For an asset to really work as collateral at scale, the whole financial system needs the plumbing, the rails, to actually use it. So let's take a look at how those rails are being built for Bitcoin as we speak.
It really boils down to 3 huge developments. First, you've got custody. Big, trusted names like Fidelity and BlackRock are now offering secure, insured storage. That's a massive green light for institutions. Second, the spot ETFs. These are a game changer because they give Bitcoin a standardized, regulated price every single day. That's crucial for getting it on a balance sheet. And third, the lending market is already here. Big lending desks are now accepting Bitcoin as collateral for serious multi-million-dollar loans.
And with all that infrastructure in place, it unlocks this really powerful strategy that some people call the never sell strategy. You see companies like MicroStrategy doing this brilliantly. They just hold their Bitcoin, then they borrow US dollars against it at a really low interest rate. They get all the cash they need to run their business, but, and this is the key, they never have to sell their core asset. They get liquid without liquidating.
Okay, so let's zoom out now. Let's go from the institutional level to the global macro stage. For decades, really for the better part of a century, U.S. Treasury bonds have been the undisputed king of collateral, the global anchor. But the argument we're looking at here suggests that that foundation, it might be starting to crack.
And if it is, that creates a huge vacuum at the center of the financial system. And you don't have to look much further than this timeline to see why. Just look at the growth of U.S. public debt. It's exponential. And remember, that debt is what's backing the Treasury bonds. So the big question this analysis poses is, can the entire world's financial system stay anchored to the debt of just one country, especially when that debt is growing this fast?
Let's just put that number up on its own for a second. $35 trillion. That's where we are today. It's a number that's so big your brain can't even really process it. And the argument goes that at some point, the rest of the world is going to start looking around for an alternative anchor, one that isn't dependent on the spending and borrowing decisions of a single government.
So if you were going to design a new global anchor from scratch, what would it look like? Well, the argument is that it would have to be a truly neutral asset. What does that mean? It means no single country can control it, its rules can't be changed for political reasons, and crucially, its supply can't be inflated away by some central bank.
And this is where it all comes together. This is the core of the whole thesis. If you take that definition, a politically neutral, uninflatable asset that nobody controls, and you scan the world for something that fits the bill, the argument is that there's really only one candidate that ticks all those boxes: Bitcoin.
So, where are we headed? What does all this mean? You've got these three massive forces all converging at the same time. You've got the unique technology of the asset itself. You have the institutional plumbing being built at lightning speed. And you have this huge macroeconomic shift creating a demand for something new. What happens when those three things collide?
Well, the argument is that what we're witnessing right now is a historic transition. It's the evolution of Bitcoin from being seen as this fringe, speculative plaything into a potential Tier 1 foundational asset for the whole financial system. It's a move from the absolute edges of finance to the very, very center.
And that really brings us to a quote that just perfectly sums up the entire argument we've been exploring. It goes like this: in finance, the asset that serves as the best collateral is the asset that dominates the world.
You know, throughout all of human history, that dominant asset has always been something physical, like gold, or something tied to a powerful country, like the US dollar. So the final, really provocative question this whole idea leaves us with is, for the very first time in history, could that dominant, world-anchoring asset be something purely digital?